Well, the joyous and vibrant Ganpati celebrations have kicked off across India, bringing together a harmonious symphony of devotion and, yes, more traffic snarls as well in Mumbai.
It was okay actually yesterday. Just went out to a few friends who had Ganpati in the building. One friend had it actually, just in the evening visited. It was not bad. We started early thinking that there would be traffic snarls, but maybe I got lucky. I don't know what's the story with you.
But that aside, this is the time when I think all of Mumbai is just in such a festive fever, and you can feel that from now, then Dussehra, then Diwali, it's the kickstart of the grand
festivities in the air, and this is when it's kick-started. And yeah, the atmosphere as well was charged up and very magical, Aisha.
Yes, was it as magical for the equity markets or not? Let's tell you, while we were away and while we were on a trading off, thanks to Ganpati, Wall Street was a little cautious ahead of Fed. There's also been a little bit of a cool off on crude as well, though it did hit that $95 per barrel mark. And yes, the dollar has been edging higher. It's now nearing that 105 level. So both the 5-year as well as the 10-year yields in the US are now at 2007 highs as well. So that's pretty much the picture. The implied Nifty is adjusted a downtick of about almost 0.5%. 20,080 levels is where it's currently at.
No, Aisha, macros are not looking fantastically strong. You wouldn't say it's a red light or something, but yeah, you've got to be cognizant of the global macros. Crude above $90, never a great news. Bond yields, why are they moving higher? If they're moving higher, that is a clear indication that global bond markets are not either they're worried about a Fed rate hike, or they feel that in the last quarter of this year, officially last quarter will start now in the next couple of days, inflation spike could be there. So you cannot ignore macros for long. Up until now, the macro setup has not been challenging for Indian micro caps and small cap and mid caps. But at a global level, if macro deteriorates, it will have impact on flows. So flows have become patchy. It will have impact on risk appetite, which seems to be waning away. So what was green has become yellow. We are not red yet. I'm not saying that there is going to be a macro-induced sell-off, but the macro setup is unlikely to be the trigger point for the market. It's no longer a tailwind. It is going to be a disruptive factor which may just limit the psychology of the market. And at above $90 crude says, I think you could ask yourself is that, okay, what happens to fiscal deficit? What happens to interest rates? What happens to macro allocations? All that narrative, it hasn't started, but I think it will start.
Okay, so it's turned yellow as of now, but no alarm signals being run off. But we'll also be tracking lots of overseas cues, and in particular, the FOMC policy decision that's going to be out later today. And it's widely expected that the central bank is likely to hold rates this time around. But it's not just that, because investors will also be clearly watching out for the kind of economic projections that the Fed Chair Jerome Powell will take, perhaps some sort of clues as to what could happen in terms of the road ahead. You've got the Fed Reserve, the so-called dot plot as well, that the charts projected that could move in the Fed funds rate. And in the press conference as well later on, US Fed Chair is likely to give some sort of an indication as to what we could see in the November meeting as well as into 2024. And that, Nikunj, is closely going to be it.
Sometimes you can say things with certainty, and I can say with a lot of certainty that Fed is not going to move. The narrative, tonight you're not going to get a rate hike or any kind of indication. I think it will be more of the obvious, which is that, okay, we cannot rule rate hike if inflation does not come back, but they're not going to be moving for the 12th rate hike, in a hurry. So that really explains that if you look at the macro mood in terms of yields, dollar index, it is not sinking in with what the Fed is likely to move. I think tonight's purely from market expectations, tonight Fed move is really centered around what they have done, rather what they will do. Wait and watch, I think, would be the watchword when it comes to the Fed commentary. Anything new, anything which is of big surprise, I think will shake the market. But for me, the way I look at the setup, what my understanding of things is, there is no way Fed would increase rates. It would be more about what they have done rather than that what they are likely to do. They will not be aggressive in terms of a rate hike trajectory also, or even a communication, because that's the last thing they want is to disrupt the financial markets right now.
Okay, that's pretty much the global setup. Yes, you are getting a little bit wobbly when it comes to the macro cues. So let's see what the Fed does. But a pause pretty much is something that's baked into the prices. But let's discuss what happened back home as well. While we were on a day's break, the Nifty managed to snap its 3-day gaining streak on Monday. Sensex, its 11-day gaining streak, HDFC Bank, Reliance, Infosys. It was a heavyweight-led drag on the index. It was the Nifty, Realty, as well as the Metal Index, which actually fell over 1%. And something interesting outside of, what the headline indexes are doing, the kind of divergence that you're seeing now within what the PSBs are doing as to what the private banks are doing.
Yeah, so let's stay with banks.
Yeah.
We called banks the defensives, and it has exactly moved as per the script. But I don't think anybody expected this kind of a rara sectoral rally in the PSB. So within banks, private banks, Monday's price action was not that superlative. Then within PSU banks, the lower you go in terms of the pecking order, higher is the attention and higher is the price action. Now, let's look at the ranked liquid smaller PSU banks. See, with large PSU banks for next couple of quarters, I don't see there is a problem in terms of valuations and also in terms of the rate cycle, trajectory, NPA cycle. But the pure participation in some of the smaller PSBs, and let's stay with that graph, please. Let's go back to that graph. We want to stay with that graph for some time to establish that what kind of, what is happening there. Now, the column in the yellow on your left hand side, that is a free float of central bank. What is free float? Well, the free float means that the amount of equity which is available in the market which could trade. And that's across demat accounts, that across minority shareholders and institutional investors. So out of the total free float of 37.4 crore in central bank, 92% traded. I rest my case. For UCO Bank, 86%. For IOB, 79%, and for Punjab and Sindh Bank, 85%. So it's like saying that almost the entire free float is trading or it is churning. This could be intraday, this could be delivery, I'm not getting there. But all I'm trying to say is that when you see a situation like this where almost 90% or the entire free float is changing, that just tells you that there is a strong momentum. The price action is dominated not by institutional investors. There is a lot of FOMO crowd there. So this is the reality. While with large cap PSU banks, I think they're still cheap, the cycle is still strong, but the pure trading inertia, when it reaches this kind of a level, you got to ask yourself why and will it sustain?
Okay, let's ask the chartists that. Let's welcome on board Kunal as well as Naresh and figure out what they're making of the market texture and of course of the constituents as well. Naresh, hi, morning. Let me come to you first. The adjusted Nifty, implied value now stands a little lower at 20,080 thereabouts. We did see some of the heavyweights come under pressure on Monday. What's your take? What is the index going to do today?
So overall, the expectation is same. We go in a slow and steady uptrend because we are yet not seeing a stronger trend in the two heavyweights, which is Reliance and HDFC Bank. So it's like having a 25% of the index not moving, and that makes it difficult for the index to have a stronger trend. So the view is 19,800 now becomes a base. The upside target continues to remain 20,500. So overall, you want to be looking at a buy on dips going forward closer to 19,800, 19,900 if and when if we get a dip. Otherwise, it's a hold at current levels. Stock specific action has started seeing a lot of say speculative action in the PSU banking side, where something like an Indian Overseas Bank has crossed market cap of Canara Bank, Union Bank, etc. So overall, we are seeing some bit of speculative action in some of the names, but overall the market still remain in a slow and steady uptrend.
Steady uptrend according to Naresh. Kunal, let's get in your take. And you've been tracking the Nifty Bank quite closely. Just owing to what we're seeing on the PSU banks as well, is there any other indicative data?
So nothing much has changed. In fact, on Friday and Monday, there was hardly any change in terms of the open interest for the Bank Nifty. I think 0.75% was the change for the Bank Nifty. So not as strong enough an indicator as compared to the cumulative last 10-12 days start of the September series for the banking index. But then also on the Nifty, I think we've not seen any major push of momentum, which says that we are meandering at the 20,000 mark plus minus 100 200 points. My expectation is that maybe in this leg of the market trend, we may probably come back below that 20,000 levels for maybe another 100 odd points. But then I think that could be a good opportunity to go for a contra long on the index. So we'll wait out for the next couple of days and see if the index settles below that 20,000 mark on the spot levels. That could probably offer a good opportunity to go for a buy on dips.
Okay, let's get in some stock ideas as well, Kunal.
So two buy calls concentrating on the defensive PSU names. Coal India is the first one which I would suggest as a buy. The stock looking quite charged up. In fact, even on Monday, the stock managed to come closer to a flag pattern breakout. So would suggest a buy with a target of 300, stop loss at 270. And NTPC in a very similar kind of a vein, the stock is going through a mild recovery after that last week of correction for the stock. So would suggest a buy on NTPC, 255 as a target, stop loss at 235.
Right, Naresh, what about your stock strategies?
So the first buy is on Hero MotoCorp with a stop loss 3,070 and a target price of 3,300. The stock in the last 2 days has shown some momentum, crossed a 1 week range. Overall, 3,200, 3,300, the recent highs in that band continues to be a resistance. We'll expecting it to test towards those levels, and if it breaks that, that could be start of a much bigger uptrend. Good enough consolidation done around that 3,000 mark, so looks like a good risk reward trade here. Second is a buy on Power Grid. The stock on an adjusted basis for bonus hit a new 52-week high and an all-time high, very close to it, around 200 odd levels. So a range breakout here in the making, and the trend across the power names has been pretty strong. So out here next would be Power Grid, which would make a move towards 220 in the short term, stop loss at 195.
Find out what exactly Kunal has on his radar as well, and we've got all the top recommendations going. All right, let's move right on then and connect with Steve Englander, who of Standard Chartered Bank, who's joining in. Thanks so much, Steve, for taking time out. And as we were discussing earlier, while the expectation is largely on the fact that the central bank is going to hold rates back in the US, do you think that the focus is largely going to be on the summary of the kind of economic projections as well that we get down the line?
I think that's very much the case. If you take a look at what's expected for the next couple of meetings, they haven't really moved very much. And as you said, there's like zero priced in for tomorrow. No one expects any kind of move. But what you're seeing is 2-year yields, 5-year yields hitting cycle highs. If you go out the curve, say to January 2025, expected Fed funds is hitting a cycle high. So I think the market is focused on what's going to happen down the road. And we think that they're going to keep a hike in 2023. And we think that they're going to take away one of the cuts in 2024. It's a signal that they haven't yet seen the economy slow down enough to justify sort of as aggressive cuts as they had last time.
My question, sir, is if Fed is unlikely to move, which seems to be the consensus, then why are bond yields spiking up? Why is the dollar index marching higher?
That's the $64,000 question. I think that we had been expecting the U.S. economy to show more signs of slowing. It really hasn't. The data are mixed, and whereas last year you had some bad GDP data, but the labor market was firm. This year the labor market looks a little bit soft, but some of the other indicators are looking more firm. And so I think the market is saying that the Fed is not going to feel any compulsion to cut rates. And some of the low inflation numbers, I think they're worried that they're coming from special factors, and that the slow inflation may last 6 months further, but ultimately could be a little bit transitory, and that there are concerns about inflation further down the road, and there are concerns about the deficit further down the road.
Do you expect a sell-off in the bond market, a further spike in the dollar index, given where commodity prices are moving?
Well, there are two factors. One is tomorrow we expect the Fed to sound a little bit hawkish. We expect them to sound a little bit hawkish, not at all like the ECB last week. It's also, just technically in the market, the momentum seems to be in favor of higher yields, and nothing seems to be stopping it. And what we've seen a couple of times is that you go into the Fed meeting, and as long as there are no big surprises, as soon as it becomes clear that there are no big surprises, the momentum trade continues. So we could see a little bit higher yields as a consequence. We don't expect a big announcement, but the market sure seems to want to sell bonds in the short term here.
Right. Okay, Steve, great to have you on the show. Thank you so much for taking the time out and joining in today. Let's move focus and let's talk about market internals, and let's talk about HDFC Bank on the takeaways of their analyst day. Now, they're saying that they're pretty comfortable about the liquidity as well as the LCR situation. The NIM guidance, they're saying is going to fall by 25 to 30 basis points, saying that they took a hit on investments in Yes as well as Bandhan, and the investments are M2M, that's mark to market. Harmonization, they said, is done with regards to their OPEX, and margins will rise by 25 to 30 basis points once liquidity actually falls in the system. Let's take on board Sameer Bhise then and try and analyze what's been his takeaway from the analyst day. Sameer, hi, morning. What, according to you, were the key highlights from HDFC Bank's analyst day? And I'm guessing the NIM guidance, the fact that they're expecting a fall by 25-30 pips, does that come as a surprise?
Yeah, hi, good morning. Thank you for having me on the show. So I think 2-3 pointers which probably market was not factoring earlier was obviously that the opening net worth of HDFC Limited is a tad lower than what most people expected. So to that extent, your starting point of net worth is a bit lower than what you thought. And also the margin drag with respect to the liquidity buildup that you had in run-up to the merger, which is 1st July 2023, is quite sizable. So that may have a further impact on the merged entity margins. And as is the case with such things, it usually takes 2 to 3 quarters for things to normalize. So near-term margin performance could be a bit subdued. So I think these two factors can just impinge on near-term performance is what we think. Though all said and done, HDFC, the franchise, obviously nobody doubts the quality of the franchise. This kind of turbulence is kind of expected with the merger of this size and this scale. Though near-term numbers could be subdued, I can't deny that, yeah.
Sameer, the fact that there would be a pressure on margin is something which the management has communicated. And the fact that the stock is underperformed, don't you think markets are already pricing this kind of a scenario?
I think one has to look at it in context of what's happening in the sector. I mean, we've had a nice 4 quarters run in other banks with respect to expanding margins when RBI was hiking rates. Other banks have now entered a territory where margins are kind of getting softer given rising cost of funds, but they are getting softer on a highly elevated base, which you saw all through FY20. Unlike HDFC Bank, wherein probably the expansion was not so high and now it's getting compressed without having expanded. I think that is where there's a bit of a hiccup. And obviously, if at all we enter a rate cutting territory next year, then obviously it's an entirely different ball game. So I think that is where the anxiety is with respect to margins. So I think in the longer term, only 2 things matter, which is growth and asset quality, wherein obviously they sound quite confident. So I think it's a time to take a slightly 1 year plus view rather than get bogged down by what's happening on an extremely near term quarter to quarter basis, because it's a big event in the life of the organization, and there are many moving parts which will take some time to settle down.
Cut your price targets. Do you expect some underperformance in the stock in the near term, Sameer?
Yeah, so I think as Nikunj said, the stock has been sideways for some time now. I think from people who really want to take a medium-term view, like almost 18 to 24 months, I think HDFC Bank doesn't get cheaper than this. Near term, yes, can't deny a bit of a sideways movement is likely given how numbers could shape up. But obviously, from a medium term perspective, our fundamental view remains positive. Our target price is 1850. We haven't made any meaningful changes to our APS estimates basis this because we were slightly already factoring bit of some of these disclosures. So I think that is where we are.
All right, thanks so much for taking time out. That's Sameer's view, saying that perhaps look at it from a slightly long-term standpoint and not on a quarterly basis, but that's the view on HDFC Bank. Let's shift gears quite literally then and talk autos first up with Anisha. She's right here with us in our studios to discuss some of the stocks on the radar. And what exactly is the view from Bank of America?
Well, Bank of America is talking about Eicher Motors, and they are talking about it quite positively because they are saying that the entire industry is likely to grow at around 8 to 10%, but Royal Enfield might likely do better given the fact that the growth is going to be led by premiumization as well as new launches, so we'll watch out for that. Separately, if you look at it, the company has planned a slew of new product launches which are there in pipeline. However, they will of course space it out given the fact that they want each of the model to run its course and see the scale up happening. So there are a lot of levers available there as well. The new products, interestingly, will address the portfolio gap which is there and will add the adjacencies to the existing brands, and this could be underscored by the rollout of the new Himalayan 450cc which will happen at end of October, and they're looking at tapping the existing customers as well for upgrades. So they are expecting almost 5 to 7% of upgrade customers might be there, and overall the new launches are also lined up, so they're quite positive about the growth going forward. But this is a trend, Nikunj, we saw play out in passenger vehicles first up, the premiumization, and now it seems to be happening a lot in the last 3 to 6 months, even in two-wheelers when there in a slew of launches have happened.
No, Nisha, look, Eicher has been commanding this premium motorcycling space for years now, and challenges have come and gone, and they've not really had an impact in terms of the leadership position. Of course, the stock went into a tizzy, into a downward spiral when you had the Harley launch and you also had the Triumph announcement from Bajaj Auto. But after that, if you look at the August dispatch numbers which have come out, or what the management has indicated in terms of where they expect the second half to go, you don't see a problem whatsoever in terms of any kind of a slowdown. So within two-wheelers, if there is one space, I mean, TVS is a play on EV, Hero MotoCorp deep contra, but there is no real evidence of a comeback. Bajaj deep contra, but exports I think will not be FY24 or 25 comeback story. Then you're left with Eicher. And I think one point which nobody is talking about, Anisha, Eicher, is that there is a very strong upgrade cycle which is at play. And if you are an RE customer and if you are used to that experiential biking with 350cc or even 500cc plus, then you are likely to upgrade it given the new model launches are coming. And this is something which I think somewhere markets are underestimating. You've always seen that there's a cult following when it comes to certain categories, and that cult following I think is not there in cars so much so as it is there in the experiential or the premium biking segment. I mean, you look at the global clubs. There's a Harley club, there's an Eicher club. You don't have a Bajaj club or Hero MotoCorp club
yet.
You'll not have it. Why? Because that's a very different. Audience. Audience is not the right one, but the customer base. So my point with Eicher is that while there's linear growth, which will all be there, people and markets are underestimating the upgrade cycle, because in 2-3 years now you will start upgrading your motorcycles, and we've seen a lot of RE350s on the road in last 3, 4, 5 years. I think they're up for upgrades, and there's a new powerful launch which is happening, which I think should give a tailwind to the company.
Okay, that's the view coming in. Perhaps we will soon see some sort of a club for Bajaj Auto. But moving away from that, it's oil and gas as well that continues to remain in the spotlight. And Anisha, why is that?
Well, oil is now at $95. That's Brent. So of course, we have been talking about that. But the impact which is happening back home is also on account of the Singapore GRMs, which have narrowed quite a bit. Remember, for the longest time, they were trading between $10, even went up to $12. But now they've squeezed down to $8 per barrel. So that is, of course, going to have an impact on the oil marketing companies back home. But what Jeffries is talking about specifically is that they're incorporating the higher oil and product prices. And the outcome of that is that they've upgraded GAIL to buy on better LPG and petchem trading profitability. profitability in FY24. However, they have downgraded BPCL to underperform as they are expecting an EBITDA loss in the second half of FY24, and that's because they're expecting steep marketing losses in the diesel category. They already had an underperform on HPCL, so they are maintaining that. For Reliance Industries, they're saying there'll be limited impact, given that they do have the refining strength quite a bit as well, and that will be partially offset by the petchem weakness and the loss in fuel retailing, however. And for city gas distribution as well, this is a limited impact. But the fact remains that the oil is on the boil, and of course with elections also impending, there are a lot of moving parts. Not sure, Nikunj, if this is the best time to buy the oil marketing companies, despite the fact that PSUs are the flavor right now.
See, with oil marketing companies, there are different structural issues, Anisha, which is there. And there is the reason why they are trading at P multiples, which are still in single digit, despite the kind of business proposition they have. But if you connect the dots here, the news what you just flagged off, GRMs are normally a function of high crude prices, which is that we've seen, let's say in 2021 or previous cycles, crude goes higher, GRMs, they go higher. It's a rarity to see that GRMs and crude cycle is moving the other way around. Now, GRMs are also a function of what the underlying demand is. So, crude is going higher. It could be, crude is a liquid commodity. It could be sentiment. It could be geopolitical in the short term, which is driving higher. But the product prices is not catching up. Inflation has already made a comeback, whether it is in vegetable prices or whether it is in oil. I was reading that olive oil prices are up 100% last 1 year. But that aside, the point I'm trying to say here is that GRMs right now are not moving higher. That means there is a demand constraint. Now, what that means, Anisha, is that you may actually not see a windfall tax which will come in. And you actually will have to now look at companies which are pure vanilla beneficiaries of high oil prices. So unlike the previous cycle where Reliance and oil marketing companies had to bear the burden or bear the cross of high inflation and high windfall tax, windfall gains, I think that may not happen because GRMs are not there. There's no profit they have. So that I think is the differentiating factor. Oil marketing companies, you should absolutely avoid them. But I will not be surprised that there could be subtle outperformance, let's say in ONGC and Oil India, because they are the biggest beneficiaries of oil.
Yeah. Okay. So we know the place to focus on and the ones to avoid in light of the crude spike up. Anisha, thanks for highlighting all the stocks this Wednesday. But we at Times Network bring to you Mirror Now Summit, Chhattisgarh.
All right, and on day 2 of the special session, the Lok Sabha and the Rajya Sabha have held their sittings in the new Parliament building. As you saw, the Prime Minister Narendra Modi has urged the MPs to reaffirm the commitment to make India a developed nation by 2047 and described the move to the new Parliament building as the beginning towards a new future. He said that Indian aspirations are reaching heights that may not have been seen in the last 1,000 years. Meanwhile, the Women's Reservation Bill was also tabled. Opposition leaders have welcomed the move but questioned the delay. Listen in to what the Prime Minister had to say.
भारत अनेक सिद्धियों के साथ नए संकल्प लेकर के नए भवन में अपना भविष्य तय करने के लिए आगे बढ़ रहा है। विज्ञान जगत में चंद्रयान 3 की गगनचुंबी सफलता हर देशवासी को गर्व से भर देती है। भारत की अध्यक्षता में G20 का असाधारण आयोजन विश्व में इच्छित प्रभाव, इस अर्थ में ये अद्वितीय उपलब्धियां हासिल करने वाला एक अवसर भारत के लिए बना। इसी आलोक में आज आधुनिक भारत और हमारे प्राचीन लोकतंत्र का प्रतीक नए संसद भवन का शुभारंभ हुआ है। सुखद संयोग है कि ये गणेश चतुर्थी का शुभ दिन है। गणेश जी शुभता और सिद्धि के देवता है। गणेश जी विवेक और ज्ञान के भी देवता है। इस पावन दिवस पर हमारा ये शुभारंभ संकल्प से सिद्धि की ओर एक नए विश्वास के साथ यात्रा को आरंभ करने का है।
All right, there you have it. That's the Prime Minister speaking, laying out some of the new goals. But let's also connect with Dipan Mehta, who's joining in on the show. Hi there, Dipan. Good to have you on board. Let's start off by your assessment then as to how you've looked at the entire PSU space, the kind of rally that we've witnessed, in particular for the PSU banks. Do you believe that there is more merit in this move?
Good morning, and thank you for having me on your show. Yes, I think they are seeing a correction of underperformance of multi-decades coming through in the last 2-3 years or so. And in times like this, when a lot of businesses are trading at very high P multiples, a lot of professional fund managers and high net worth investors feel there is comfort in the PSU stocks where there is still reasonable valuations. And on the whole, I think the performance has been pretty decent across the board if you look at the PSU companies, perhaps with the exception of oil marketing companies, whether it's the engineering companies or the NBFCs or even the public sector banks, the defense companies, the shipbuilders. I think there's a new, I would say, resurgence of growth in all the PSU stocks, and that is capturing the attention and the, I would say, fancy of the investors as well. So maybe at corrections, if you get into PSU companies, it may still be a great trading opportunity. And valuations, as I see them, there's a good scope for still further re-rating of the P multiple, especially on the PSU bank side and the PSU NBFCs.
Sure. Dipan, aside of that, let's throw focus on what's happening in the primary market, because just so much paper is hitting the bourses almost on a daily basis. And I was just looking at the subscription figures and the kind of gains some of the recent listings have made from the issue prices. They're looking pretty handsome. I mean, gone are the days of the class of 21, your Nykas, Paytms, which listed with a lot of exuberance, and then we all know what happened after. But that aside, any of the new paper that's interested you? I mean, I was just looking at Yatra, for instance. It's pretty much a subscribe across the board.
See, I think the entire structure of the primary market has changed, and therefore, from a high net worth investor's perspective, you hardly get any allocation in any of the new IPO listings. Secondly, every IPO, I really go look for only one data point, which is the price to earnings multiple at which they are offering. And I still feel that the valuations of all the primary market issuances is higher than a peer group company in the listed space. So broadly, I would like to avoid all these new IPOs and wait for a year, 2 years for the stock price to settle down. We would have 5-6 quarters of earnings, see how the company has performed post listing. There'll be some listing history as well, and then perhaps make a call. The only silver lining is that so many interesting companies, although expensive, are getting listed, and who knows, 2-3 years down the line, our choice of investee companies may only increase with the kind of interesting companies going public.
Right, stay on with us, Dipan. Just going to take a quick detour and connect with Kiran Mazumdar-Shaw, the Executive Chairperson at Biocon, as well as Peter Bains, who has been appointed as the Group CEO. Thanks so much for taking time out. Kiran, going to come to you first to get in a view as to what exactly are going to be, the KRAs for Mr. Peter in terms of what is going to be the immediate priority, what kind of value creation you're trying to achieve with this appointment.
I'd like to start by saying that every one of our individual businesses is at an inflection point of high growth. And we believe that this is an opportunity for us to really create premium growth at a group level. So that is what I think this strategy is about, of bringing someone like Peter in, because at the moment, what is being valued is really individual businesses. But what is not being valued correctly, we believe, is the group value that is brought together by these three businesses. I think Biocon Group is a very unique business entity in the sense that it brings very important complementary businesses under one roof. And it provides every stakeholder a huge value creation opportunity in terms of investment. And we believe as a business, it is also a huge value creating opportunity for us. And bringing in someone like Peter, who actually is not only a veteran when it comes to the pharma and biopharma industry in terms of his global experience, but he is also someone who understands the Biocon group because he has basically played a very key role in one of the group businesses, which is Syngene. But through that experience, he has also understood the Biocon business very well because many of the capabilities and competencies that Biocon had was leveraged by Syngene during his time. So he knows what this group synergy is all about. So coming to his mandate, I think Peter is very clear that he's going to focus on making sure that the group strategy reflects the synergistic strategies at the individual levels. So his main focus is going to be to work with the CEOs on their strategies, refine them, and make sure that they are dovetailed extremely well at a group level so that the group benefits from every one of the businesses.
Right. Kiran, hi, morning. So how do you, say the CEO's work along with the group CEO's position as well now, considering that all three businesses are quite independent of each other? Can you share some sense on how a group CEO would look to intervene in the existing structure?
So I will start and then Peter can add to it. But I will start by saying that, look, as far as each CEO is concerned, they will work very independently and autonomously. But like I just said, there are many aspects of our businesses which actually have commonality. For example, between the three businesses, we have put in place large capacities, whether it is biomanufacturing, whether it's drug products, both oral dosage and injectables, whether it's small molecule, APIs. These businesses are, in terms of manufacturing scale and capacity, are at global scale. And I think each one of our businesses can and has been leveraging these capacities as and when required. But I think the opportunity that lies ahead is really to ensure that we minimize idle capacity across the group. And that's something that Peter will look into. So Peter, over to you.
Okay, so can you share the timeline for Biocon Biologics IPO? Can one say that the IPO preparation is underway for the group?
I don't think I'll be able to give you any more optics in terms of the timelines than what I have shared in the past. I think we really need to look at certain triggers that will help us to, hit those, dates that we are looking at. I've clearly indicated that we certainly want to look at an IPO within 2 years. And, a lot of it depends on many, many aspects, markets, the business triggers, and the urgency of doing such IPOs. So I think we will look at all these very carefully.
Right. And any update, Kiran, on insulin aspart approval timeline?
Well, right now I have nothing, firm to inform you, but I just hope that we will get this approval hopefully very soon. So that's all I can say. But it's at this stage, it's all I can say is it's hope, not I don't have any clear optics on whether this is going to happen.
All right. And any guidance when Biocon can expect to launch the biosimilar aflibercept in the US? And will Biocon get the interchangeability?
Look, these are questions that are better answered a few months down the line. Right now, all I can say is this: yes, we do, hope to be the first approved aflibercept. You saw the nod we got from the EU authorities, the European authorities, and we hope we get a nod from the US FDA too. But a lot depends on patent expiration dates. A lot depends on the discussions that we have with innovators, etc., etc.
Sure. Lastly, in the small molecule business, Kiran, when is the new facility at Visakhapatnam getting commercialized?
No, it is already in the commissioning stage, and we do hope to operationalize it by the end of this year. So I think you will start seeing exports taking place hopefully quite soon.
Right. Great to have you on the show. Thank you so much for taking the time out and joining in today, Kiran. Let's get back to our conversation. And Dipan just wanted to flag off the Analyst Day takeaways from HDFC Bank. The fact that they're saying that, they are expecting the NIMs to fall by 25 to 30 basis points. The NIM guidance, of course, factors in the excess liquidity. Wanted to understand whether you see the stock going to be sideways for some more time to come, and if you perceive as this consolidation in the stock price as a good time to buy for the long-term investors or add in more positions.
Yeah, I think first of all, a lot of investors already own HDFC Bank from whatever portfolios we are seeing, and therefore, in terms of risk profiling the portfolio, there's not much scope to add more HDFC Bank. And also another factor is that there is no really trigger coming in for the stock price to move up. Triggers could be in the form of significantly better performance, better than what the street is expecting, or some positive news flow. We can't say what that may be. Stock, I mean, all know has been, going sideways for a very long period of time, has in fact underperformed. Valuations also have come off historical levels and perhaps cheaper than some other peer group companies. So it's just a matter of time when the stock starts to do well. It's just that we don't know at which point of time the outperformance will start. All I can say is that HDFC Bank is a fabulous play on the Indian economy. The Indian economy per se is doing well. Stock market is doing well as well. So there's no way that HDFC Bank will remain a laggard for very long. I think that when we see solid FII flows coming into the country, that's when we see the likes of HDFC Bank do extremely well, because it's more of a liquidity issue in terms of buyers and sellers in HDFC Bank rather than the actual fundamentals of the company.
All right, from HDFC Bank, let's put the spotlight on PSBs because those are on the editor's radar today. Discussing the fiery run-up in some of these stocks, the valuation picture and the key triggers, Nikunj, all critical.
Look, you have to look at banks. One side you've got HDFC Bank, which is underperforming, and you've got this charged up move over a frenzied rally in some of the small PSU banks. I'm going to use the word small and PSUs here. PNB is not small, but it also has seen a fiery run-up. So let's focus on UCO Bank and Central Bank and some other banks from the small from the small cap PSU banking space. You can throw in, let's say, Bank of Maharashtra. You can throw in a BOI. So there are a lot of banks which within the small PSU banking space have been on a tear. But why am I saying but? Now, on an average, these stocks have seen 12 to 15% move on Monday. Now, focus on the yellow column. This is the free float. To break it for our viewers, free float is the total share which is available in the market, which is held by minority shareholders and not by promoters, which can trade on a daily basis. Now, Central Bank on Monday traded 34 crore shares. That's 92% of the free float. For UCO Bank, the number is 86%. For Punjab and Sindh Bank, the number is 85%. Now, what is unique about this? Well, it is saying that almost the entire free float on intraday basis now seems to be trading. This could be intraday, this could be delivery, this could be new buyers getting in, old buyers getting out. But when we've seen this kind of a frenzy move in PSU banks and small tier PSU banks, let's say in 2022 or 2021, I'm afraid the end game has been very bad.
Okay.
So while the trajectory for banks, the sector, large cap PSU banks, cycle, capex, everything I think is looking fantastic. But the price action in some of the small tier PSU banks is something which you just need to be a bit careful of. I'm not saying it's a red light. I'm not saying the sector bull run is over. All I'm saying is that when you're buying some of these stocks only for price and momentum after the recent run up in these small PSU banks, you could ask yourself why, understand risks, and if you can manage risk, well, then might as well.
Okay, there you have it. The devil is in the detail, and that's one critical point that we're flagging off, Aisha, when it comes to the PSU banks.
Oh yeah, absolutely. Deepan, wanted to get your take in as well. Dichotomy between what the private banking lot is doing and PSBs. How are you approaching PSBs now? What's the call there?
See, per se, we are a bit cautious on the market and therefore, wouldn't advocate fresh purchases and perhaps any counter, including PSB stocks. And the dichotomy is nothing new. It has been around for decades and decades. And the reason for that is PSU banks have got into a muddle many times in the past. And their overall growth rates also are significantly lower. But I think in an oasis, they are an oasis of cheap valuation in a market where price to earnings multiple are extremely high. And investors, I think, have the comfort that next 2-3 years will be pretty decent for PSU banks. Because the NPA cycle should not worsen, and also these PSU banks are lending more and more to retail, which is much more safe. So from that point of view, there is a compelling story in PSU banks. It's just that we don't know when this NPA cycle will turn even on the retail side, and at that point of time, how these companies will actually manage those bad debts, if at all. That's a bit of uncertainty, but that's, I think, somewhere in the future. In the meantime, as I said earlier, there is scope for the valuation ratios, the P multiple price to book to be re-rated upwards. And certainly there's a trading rally in PSU banks as well. I think every time the quarterly results will come, we will see positive surprises. So yes, the entire outlook looks positive, but our outlook on the market generally is slightly cautious. So one should keep that in mind as well.
Right. Okay, a lot of other stocks as well and strategy notes which have come out while we were away on a trading holiday. Jefferies has come up with its strategy for India. Let me take it across to Anisha for the highlights.
Well, yes, Jefferies has actually come out with note and they're signaling the, cautionary tale because they are talking about how the valuations have become quite ripe for the Indian markets and that's why they're moving into the cash a bit. So that's a key takeaway coming in as far as Jefferies is concerned, and they're also talking about how they have changed their stance regarding a couple of these sectors, and I'll just highlight that in a minute. So they've, yes, trimmed the weight on property, mid-cap industrial, staples, and they've managed to add positions into Bharti as well as they're adding the cash positions as well. They are saying that while political continuity is likely to be there in 2024, the fiscal pressures are building up on one hand. You also have the prices rising up and the potential reallocation that might happen towards social infrastructure. That might mean that there might be more pressure on the government to increase the pace of PSU divestment as well. So that's the other thing that they're talking about. The Nifty, as per them, which is currently trading above 20,000 mark, has the 1 year forward valuation of 19 times, which is one standard deviation higher than the average, and it's higher than the 10-year average as well. And the preferred yields to gap, which is the gap between the 10-year versus what the valuation is, that is also a bit elevated, and that is giving them the discomfort as far as valuation is concerned. While they are saying that yes, there is this theme which is ongoing higher for longer, but there are risks to it. They are, saying that the rich valuations is a bit of a problem. They would buy on dips as the medium term appears to be quite bright, but at least in the near term and absolute near term, they are a bit caution. They are talking about being a bit caution in the market, and that's why they're raising the cash levels in the model portfolio.
Okay, thanks a lot for that. Everybody seems to be, having the same advice that you got to be slightly more cautious. The margin of safety is not there and the valuations is not that great. I mean, I look at the market very differently. I would say we are out of the teens. Yes, you're out of the teens because you are 20,000 plus. Markets may be at an all-time high, but for large cap stocks, valuations are not at an all-time high. And that is something which we must recognize, that historically bull markets have turned when there is a macro crisis, 2000, 2008, 2020. There is no macro crisis on the horizon. So you can't say the bull market is over. Then you would simply need to avoid costly mistakes. And what are costly mistakes in this market? Well, costly mistakes are if you're buying momentum, tip in a lift kind of a scenario, you're buying some of those, overheated pockets. I mean, everybody knows what are the overheated pockets. Some PSU names, some defense names, few space or new India names. As long as you avoid them, as long as you don't make big blunders in this market, I think there's nothing to worry. And Dipen, isn't that the bottom line? That markets may be out of the teens, but markets at an all-time high, but valuations are not at an all-time high. Just avoid costly mistakes, keep the faith, prepare yourself for some volatility and stay the course.
Absolutely. I think Nikunj really pearls of wisdom, I must say. And, I think that investors should not get carried away because markets are at all-time high and chase momentum. As you say, I completely agree with that. And more importantly, I think mentally prepare yourself for a correction. You have been rewarded for your patience and conviction over the last 2, 3 years. Stock prices have perhaps, been underperforming as an asset class, but now a lot of returns have come through. And it's just best to, sit tight for some time. There's an earnings season around the corner. There will be a lot of intraday stock volatility around the time the results are announced. Those could be good entry or exit opportunities. And I would say it's better to stay a little light, trim your portfolio, get out of the underperformers, maybe recalibrate and rebalance so that you are, very much in line with, having a decent sector-wise exposure as well. And just wait and watch. I think sometimes inactivity in itself is, can do a great deal of positivity to the portfolio returns.
And Dipan, because of the elevated levels in the market, you think the scope for volatility this earnings season is going to be higher because the markets are going to punish those companies which fail to deliver amidst heightened expectations, I guess.
Yeah, I think that's a fantastic angle. You're absolutely right that we are entering this earnings season on a high, and even a minor disappointment, I would say, even if they meet the earnings expectations of the analysts, stock prices could correct thereafter. So that's certainly that phenomena, sell on news may play out. And really, I think from this point on, what is going to be the trigger for the market to go by another 1,000, 2,000 points on the Nifty? I mean, it's going to be a slow process. And along the way, you should expect some amount of correction. The only thing is that suddenly if global markets start to do exceedingly well, and we have a huge risk on trade and massive FI inflows, then I think, the stock price can go up even higher from these levels. But apart from that particular, upside potential, I'm really looking for further triggers for the stock market to move up from these levels. And as I said, I think, intuitively you do feel that there should be a correction. It could be healthy, shake out a lot of the weak players and provide an opportunity to get into good quality businesses at reasonable valuations with margin of safety.
The dollar index is at 105, crude is at 94.95. So while you were away, in case you've just tuned in, well, this is what's happened to the world. Let's look at that graphic. Dollar index 105 plus, Nifty. That's the US market indicator for you. But look at while you were away in terms of, what the mood point is. Just come up on your screen. That's the US market indicator, 4.3%. The VIX is at 14. And the dollar index now is at 105. So the macro ripple, if I may use the word, the macro ripple now seems to be, coming back. Dipan Mehta, I was reading in the morning and something which you would like to know. Olive oil prices are up 100%. Since you are very health conscious, 100% olive oil prices. What will happen to your salad dressings now?
Yeah, really, Nikunj, we live in very unusual times. And, first it's tomatoes, which go into Italian, cuisine. Now with olive oil also going up, God knows what next. And my wife tells me that vegetable prices come hail, come storm, just keep on moving higher and higher, especially the exotic ones that go into salads and stuff like that. So I think this is the really, I would say, very unusual, and we can't make out what is going to really happen over here. All we can say is that inflation is a reality. And despite that, if stock prices are going up, one needs to be a bit careful. And let's see what the central bankers have to say. I think it's an important week from that point of view as well.
Kunal, फर्क नहीं पड़ता ना. I mean, it doesn't matter. I don't consume olive oil. Yeah. But let me tell you, edible oil prices have also gone up 27%. So bhujia, samosa, Diwali, Dashera, don't think about it.
I think it's been the trend.
I was at a Ganpati celebration in somebody's house, and the samosa size had actually become smaller. Trust me. Maybe I'm imagining it, but that's inflation does it to you, Aisha.
Maybe they kept it smaller so that you could enjoy
Last year
everything else also.
Last year it was rather big. So maybe it's my assumption. We always tend to measure things like that, but yeah.
You're one of those guests, huh? Who measures the samosa size.
No, I refrained myself from eating it, but I was just curious. I'm very curious, so just observe the world around us. Yes, no bhujia.
Yeah, no bhujia, no samosas.
This time, vegetable oil prices have also gone up 27%. So, Dipin, that brings me to my next point. That is the time to get out of commodity consumers now. That trade, what we saw for the quarter gone by, where we saw margin expansion in FMCG, margin expansion in consumer producers, autos, everything now could reverse in the last quarter.
See, if you have a trading mentality, certainly I think commodities do offer potential. Valuations are reasonable. There could be a decent trading rally. Crude oil prices have moved up, and other commodity prices also may start to do well. Sugar, for example, also is sweet spot from that point of view. But from a long-term investment perspective, and our focus is on buying quality businesses at reasonable valuations. Then such raw material spikes, they lead to, perhaps a temporary quarter, where the margins are under a lot of pressure, quarter on quarter, year on year decline in net profits, and then stock price correct by 15-20% or so. And those are good entry levels if you have a 2, 3, 5 year type of a view. Because if you go back into history, a lot of the commodity consumers, the good quality ones, have been able to manage this inflation and yet sustain decent growth rates and create value. It's just that these are temporary setbacks and one could take advantage of it. So that's the way I look at it, because our focus, as I said, is more on the longer term picture, the big picture, 3 to 5 year type of a horizon. And really, I haven't really made a lot of money buying commodity stocks per se. So it's just kind of a personal preference type of an investment strategy.
Fair enough. Meantime, as part of the Jefferies India strategy, they're talking about how the rich valuations as well as fiscal worries that could raise market volatility. And part of that is that they have said that consumer staples as a sector is now moving to a bit of an underweight stance. Dipan, just curious to get in your take as well on the entire consumer staples basket.
See, I think that in the event of there being a correction as we are expecting, that could be one, I would say, safe spot per se. But by and large, I think you look at the valuations, you look at the volume, underlying volume growth rate, and it's not that exciting. There's hardly any scope for Ps to get re-rated upwards, and a lot of product categories are pretty much mature. I don't know how the rural markets are going to fare this time around, given that monsoons have been very erratic and they have been pretty bad in a few areas. So from that point of view, the risk return profile doesn't favor consumer staples. But yes, I think consumer oriented businesses per se is a very strong investment theme. But we would prefer to play through sectors like aviation, hospitality, healthcare, maybe retail, building product materials. Those are the ones which are the new, I would say, the new FMCG, which have the potential to grow at 15-20% top line for many, many years. And accordingly, I think could turn out to be great value creators and nice compounding stories as well.
So, Dipin, just a standard advice, more like a house advice from me. For those who've made money in defense, railways and shipbuilding stocks, should they sit on them because this is a multi-year trend, or it is now time to seriously take 25-30% chips off the table?
No, Nikunj, it is never. I think this is the mistake a lot of investors make, that the minute they see the stock price going up and they're sitting on some profit, they want to try and sell it off and then maybe try and buy it low. It never really happens. See, the underlying fundamentals are very strong. They are improving all the time. Look at the way the new order inflows are coming for the entire PSU defense companies. And, these companies have got into completely new growth phases. Who knows where it will lead to, So just stay put, I think, not doing anything when it comes to PSU defense companies or even some of the other winning stocks which you have got is a very good strategy. don't get too perturbed because the price to earning multiple has gone to 30, 40, 50, 100, whatever. In my opinion, so long as the company continues to deliver on the quarterly front and the fundamentals haven't changed, the underlying growth momentum hasn't changed, it's best to just remain invested. And I can tell you this from decades of experience. That's how you find, that's how you get multi-bagger returns, by just staying put for 3 years, 4 years, 5 years, and not, trying to do this entry exit kind of a strategy.
All right. Thanks so much then, Dipan, for joining in and sharing with us your outlook on the markets. Meantime, let's also get in a take as to what's happening with the currency, by the way, because we ended at a record closing low of 83.27 to the US dollar. And now I think we further breached those levels. So continue to see weakness in the rupee versus the US dollar, and now quoting at about 83.23 thereabouts. So continuing to hover around those lows versus the greenback. Let's find out some mid-cap trading strategies as well as a view on the currency. Kunal, your view on the rupee dollar as well as your mid-cap call?
Yeah, there seems to be a interesting breakdown of sorts for the currency, because 83 has been the major pivot point in terms of the resistance, but I think, or rather in this case, it's a support. But I believe with the breakdown, we may probably see some bit of more drop into the prices. 83.75 approximately, or 83.5 seems to be the next retracement or extension support for the rupee. So we'll have to see that whether the rupee 83.5 to 83.75, that's the next level of support for the rupee. So we'll see whether the rupee actually comes back to that level or not. In terms of mid-cap names, IDFC Limited. So I've been bullish on IDFC First Bank. Even IDFC Limited, I think, is getting into a zone of a bit oversold on the indicators. 125.26 is where the stock is trading. So would go for a buy. Targets of 133, stop loss 122.
Okay, Kunal, those are your trading strategies. Let's find out what's on Naresh's radar as well. Naresh?
So that's a buy on DCB Bank with a stop loss at 118 and a target price of 140. The stock has been a major underperformer for the last 2 years. The interesting case was day before, the stock saw almost the highest volume in the last 2 months. Made a base around 110 to 115. Yesterday was a 2-week breakout, the range breakout. So this could be start of a potential upside. And we've seen a lot of private small cap banks do well. So this could be a good risk reward trade here.
Right, let's move right on then and tell you about some of the other top stories that we're tracking. And retail giants Amazon and Target are going on a hiring spree ahead of the holiday rush. Amazon plans to hire 250,000 workers, while Target said it will hire as many as 100,000 workers. This move comes on the backdrop of predictions that the sales growth during the holiday period could be half of what it was last year due to higher prices. Meantime, Micron Technology is scheduled to break ground in the semiconductor testing and assembly plant in Gujarat on Sunday. This is just 3 months after the US chip maker announced its intent to set up its facility. The plant could be operational by late 2024. And with the diplomatic relations between India and Canada souring amid the row over the death of a Sikh separatist leader, Hardeep Singh Nijjar, the Canadian government has updated its travel advisory, asking citizens to avoid all travel to the Union Territory of Jammu and Kashmir due to the unpredictable security situation. It also cautioned travel to the northeast, Gujarat, Punjab, and Rajasthan. And 4 more tiger cubs were found dead in the Nilgiris district. Officials said that the cubs had starved to death after being abandoned by their mother. Additionally, 7 leopard cubs have also died of a viral infection, and this was in the outskirts of Bengaluru.
All right, kya khabar hai? And to get all the khabar just before the bell, let's go to Sharad.
Well, yes, in focus we are having Bandhan Bank, and what we are hearing from the market and what the market buzz is that Arvind Vora is expected to be appointed as the executive director of Bandhan Bank. Now the interesting name is coming in the banking circles, and Arvind Vora is currently the country head retail branch banking for HDFC Bank, and also he's a board member in HDFC Securities. Also importantly, emailed queries were sent from ET Now, where the answers have not been coming in from the bank. Now also HDFC Bank is having roughly 5% stake in Bandhan Bank, and earlier this stake was held by HDFC Group. And from the market buzzes, what we are hearing is that a candidate is also being finalized for the post of CFO position for Bandhan Bank, and the likely announcement is expected to come within the next 1 to 2 months.
Thanks very much, Sharad, for those details. Let's move right on and revisit the stocks on the editor's radar. It's PSU banks that are in focus, particularly some of the small names.
Look, you have to look at banks. One side you've got HDFC Bank, which is underperforming, and you've got this charged up move over frenzied rally in some of the small PSU banks. I'm going to use the word small and PSUs here. PNB is not small, but it also has seen a fiery run-up. So let's focus on UCO Bank and Central Bank and some other banks from the small banking, from the small cap PSU banking space. You can throw in, let's say, Bank of Maharashtra. You can throw in a BOI. So there are a lot of banks which within the small PSU banking space have been on a tear. But why am I saying but? Now, on an average, these stocks have seen 12 to 15% move on Monday. Now, focus on the yellow column. This is the free float. To break it for our viewers, free float is the total share which is available in the market, which is held by minority shareholders and not by promoters, which can trade on a daily basis. Now, Central Bank on Monday traded 34 crore shares. That's 92% of the free float. For UCO Bank, the number is 86%. For Punjab and Sindh Bank, the number is 85%. Now, what is unique about this? Well, it is saying that almost the entire free float on intraday basis now seems to be trading. This could be intraday, this could be delivery, this could be new buyers getting in, old buyers getting out. But when we've seen this kind of a frenzy move in PSU banks and small tier PSU banks, let's say in 2022 or 2021, I'm afraid the end game has been very bad. Okay. So while the trajectory for banks, the sector, large cap PSU banks, cycle, capex, everything I think is looking fantastic. But the price action in some of the small tier PSU banks is something which you just need to be a bit careful of. I'm not saying it's a red light. I'm not saying the sector bull run is over. All I'm saying is that when you're buying some of these stocks only for price and momentum after the recent run up in these small PSU banks, you could ask yourself why, understand risks, and if you can manage risk, well, then might as well. Rupee 83.24. So crude higher, rupee lower, put them together. Macro tailwinds, not there. Macro headwinds will start if we stay where we are. 83.24, and it's almost at a new high. Today it's not dropped substantially. Where's the dollar index? Because I think large part of this is also because of the dollar interplay index which has happened. Frankly, last time when the market was in a freeze mode or was in a panic mode, that time the dollar index actually had touched 115. But even though the dollar index is 105, rupee has inched lower there, even though a lot of on the macro front are fiscal deficit concerns or trade deficit concerns have been taken care of. So this in a sense becomes this watchword going forward. Naresh, let's revisit small tier PSU banks. They were the talking point on Monday, they were the talking point on Thursday, and they were the talking point last Friday. Could it be another great Wednesday for small tier PSU banks?
So my view is negative on the small tier PSU banks, purely for the fact that the speculation has been much higher. The delivery volumes are 10 to 15%. A lot of these names have gone up high in terms of market caps. They may still be double-digit stocks. For example, an Indian overseas bank is now greater than Canara Bank, Union Bank of India in terms of market cap. It is not that big a bank, supposedly. Even on some cases like price to book, the stock is one of the most expensive banks in India types. The last time these stocks saw similar speculation was in November and December 2022. An Indian overseas bank went up from 18 to almost 37 and came back all the way to 2022 levels. So the correction on the downside could also be much bigger. So one has to be extremely careful. So a lot of these smaller ones have seen a lot of speculation. Same is the case with the PSB bank, etc. So if somebody is looking out for say PSU banks, your best place with State Bank of India, and then maybe you could go to a PNB and a Bank of, but would be a strict avoid on all these smaller tier banks.
Right, there you have it, a strict avoid on some of those smaller banks. But let's also find out what the index strategies are from our chartists. What is it that they're flagging off on the index? And it looks like it's a hold call coming in across the board from our chartists, owing to the fact that on Monday's trading session as well, we did see a move above the 20K mark as the markets did manage to hold out. And for this morning, the pre-open rates, though, indicating that it could be a bit of a sluggish start. Let's also check in on the views on the Nifty Bank Index, and it's a consensus hold call. That seems to be the view coming in from our chartists on the market moodometer.
Naresh, IDFC First Bank, that in a sense has been the poster boy of this entire banking rally.
So the stock has already done really well. From being a stock which was at 30 rupees, the stock has gone up to almost 100 rupees. And now has started giving first signs of a pause. We saw a big MSCI tick also. So overall, a pause at 100 rupees is what it looks like. Could go into a range of 100 to 85 for the short term. The longer term trend is still positive, because once we start such a trend, we don't really stop out easily, but it needs to go through consolidations. So the stock looks interesting, but I would expect some bit of a consolidation. But whenever it crosses 100, that could again be a time to actually start participating in the stock.
Okay, that's the view coming in on an IDFC First Bank. Meantime, also wanted to get in a take from you, Naresh, as to what the sense is when it comes to, some of the large cap names within the IT space. How are you looking at a pickup in the likes of a TCS and Infy, HCL Tech on the charts?
So TCS has made a promising price action move over the last 1 week. It crossed the highs, which were there around 35-50 levels. And the stock had been an underperformer in the previous cycle of 2020 to 21, but in the near term, the stock did not fall as much as the rest of the IT names, and now has been first off the block. So if you look at it in terms of a large stock, that's the only stock which is down only 10-15% from the top. So TCS looks pretty promising. HCL Tech is the next one, which has clearly shown a relative strength. The stock made that breakout about 1200, slowly and steadily up, not far away from the all-time highs of 1350, 1380. A little overrun in the short term, but a buy on dips on HCL Tech. Infosys has been a relative laggard, wherein the stock has been making a lot of lower tops over the last 1.5 years. This move also has been a slow and steady move. So out here, short-term topping out signs seen in Infosys. So the focus would be to either look at mid-cap IT names or look at something like a TCS and HCL Tech in the IT sector.
It's going to be a shade of red on the screen when markets will open, because SGX and global markets and the GIFT Nifty, I beg your pardon, not SGX, it's GIFT Nifty, are indicating to a downward trend, and 20,000 on the Nifty spot could really be broken. Is it broken? Yes, looks like it has been. No, it's just there, 3 points up, 4-5 points up on the Nifty in terms of defending 20,000, but 127 points down for the Nifty. For the Sensex, it's a downtick of about 500 points. What is leading the drag? I think it has to be banks, and it has to be HDFC Bank. HDFC Bank is the one where you've seen a lot of downgrades from brokerages which have come out. Now this in a sense was a stock which was been waiting where the rally has been overdue, but post the analyst meeting look like it's going to get pushed back. So now the sumo stocks, Reliance, HDFC Bank, Kotak, all those sumo stocks are not going to participate, which is just going to jam the Nifty upside. But meanwhile, there is definitely a selling which has emerged in PSU banks in general. UCO Bank, Bank of Maharashtra, there seems to be reversal in IOB, and there clearly seems to be reversal even in Punjab National Bank. So is this one of those day out or day of reckoning for mid-tier PSU banks? But the screen today in terms of the market breadth, which was near perfect on Friday and again on Monday, now seems to be showing signs of clear fatigue, and the numbers on your screen, the breadth of the market in favor of declines, 1:1 actually broadly.
Let's check in on what Biocon is up to. The board has appointed Peter Baines as the group CEO. You just heard from both Kiran Mazumdar-Shaw as well as Peter Baines just a short while back. GAIL, wherein there is a Jefferies upgrade to a buy from the earlier underperform. They've hiked the target price also to 136. A very marginal start or marginal uptick there for GAIL. HDFC Bank, I want to check in on that because after the analyst day takeaways, Macquarie has maintained its outperform rating with a target price of 21.10. Remember the merged numbers, some negative surprises have come in there. And that's a big crack actually on HDFC Bank. HDFC Bank falling 3% itself is weighing heavy on the index, which by the way, Nikunj now has slipped sub the 20k mark. So HDFC Bank is that one key drag on the index and it's now falling over 3%. I don't know if we can bring out the tick by tick chart of HDFC Bank because HDFC Bank along with the PSBs is single-handedly weighing heavy on the markets. Blue Star, it's a QIP up to about 1,000 crore rupees, floor price at 784.55. There's also Al Cargo. That's another stock which is in focus. There's BPCL as well, a Jefferies downgrade coming in to underperform from the earlier hope. So these are a bunch of stocks which are going to be in focus. There's Reliance as well. Jio has launched Jio Air Fiber services in 8 cities starting at 599 rupees. But Reliance also not participating in the move today on the upside at least. There's Zydus Life, wherein the US FDA has now cleared formulation manufacturing facility at SEC2 in Ahmedabad for them. Not seeing a positive reaction there as well. And what is Tata Motors up to? After news coming by on Monday post-market hours that they're looking to hike CV prices by up to 3% effective October 1st, Tata Motors starts off absolutely flat. But single-handedly, it's HDFC Bank which is dragging the index lower. Kunal, what